domestic product has remained lower than some of her African peers. Estimates from the World Bank indicate that Kenya's average tax collection as a share of GDP between 2014 and 2019 was around 16%, whereas the share in other African countries such as Botswana, Namibia, South Africa was over 20%. Now let me just give you a snapshot in relation to what exactly this means. This is the tax revenue as a share of the total number of goods and services produced in a specific country. Now Botswana is over there with 22.7%, and we have Namibia very high at 31.8%. South Africa coming in at 26.7%, and Kenya at 16.0%. Now, of course, this is quite a key concern when it comes to matters in relation to tax collection. The government has been paramount to ensure that everybody contributes to the tax collection in the country, but there have been some headwinds in relation to this. Now, of course, the budget is our focus for today's discussion, but before that, we will give you this report where we talk about why the budget is very important for you and businesses in the country. Kenya's national budget is a document that presents the government's proposed revenues and spending priorities for a given financial year. Just like a domestic budget at household level, the budget is important as it outlines one's projected expenditure as well as how one intends to secure his or her revenue.
By understanding the whole issue about budget, you actually understand what the government want to spend in and where it is going to get the money. Remember, it is going to get the money from your taxes, and therefore it is important for you to know anytime you hear the government talking about budget and the government expenditure, it has either to get the money from your pocket or some in your business or somewhere where it will affect you directly or indirectly.
Simply put, it is divided into two key parts: income and expenses. Under income, we have taxes such as corporation tax, pay as you earn, withholding tax such as interest and dividends, excise duty that is imposed on goods manufactured in Kenya or imported into Kenya, capital gains tax that is chargeable on the whole of a gain which accrues to a company or an individual upon transfer of property situated in Kenya. Others include betting tax that is chargeable on the gross gaming revenue, and stamp duty that is charged on transfer of properties, shares and stock. The government imposes these taxes on products, services and income. But what exactly does it do with all this money? It is spent on key sectors of the economy such as infrastructure, poverty reduction, food security, job creation and education. All right, so income tax and value-added tax have been the main contributors to the slower growth in tax revenue collection relative to the economic performance in Kenya. Income tax as a share of GDP declined from about 8% in 2014 to about 6% in 2020-2021, while VAT declined from about 4% to 3.6%. Karaya Mukaya is the partner in charge of tax and advisory function at SKM Africa. Thank you so much for joining us on Business Cafe. Welcome to the program.
Thank you, Brenda, for having me.
All right. When you're looking at the tax collection landscape, we have the income tax and the VAT, which both of them have been declining as a share of the gross domestic product. What exactly is leading to this? What can be attributed to this factor?
Thanks very much, and that's a very good question. The major cause of the decline in tax as a ratio to GDP is essentially the biggest composition of our income bracket, that is the informal sector, which accounts to a very big market in this country. And we also have very many projects which are currently going on in the country which are tax exempt. So those two aspects do not contribute to the GDP, and the effect not being felt in the GDP brings the tax contribution to the GDP are quite low.
All right, and like you're saying, there are certain sectors that are a bit challenging when it comes to taxing. A specific one is the agriculture sector. It contributes slightly over 20% to the gross domestic product, but it's very difficult to account for the indirect costs and the direct costs. What can government do in relation to this?
For agriculture sector, the biggest issue is the composition of the small-scale nature of that particular sector. We have very many farmers who are doing agriculture in subsistence scale. And getting information relating to the inputs and outputs is quite a big deal for the government. And also getting to tax these particular individuals is quite difficult. So in essence, their contribution, their accurate contribution, measurement to the GDP is a big issue because of the scale in which they operate. And that is the same issue with the informal sector. As far as we do not empower these people to adopt, a bookkeeping sort of measure, so that we have the information to enable government to make an accurate measurement of their contribution to GDP. We'll continue to have this issue for both agriculture sector and the informal sector. But perhaps what I could add is, we have so many projects which are going on in the country, and some of them are projects which have been negotiated at government level, state-to-state sort of contracts. And most of these projects are tax exempt. So whereas those projects are worth billions of Kenya shillings, there is no tax effect on those projects. Those projects are not taxable. Either the inputs, those particular projects are VAT exempt, they are custom duty exempt, they are excise duty exempt, and therefore we do not collect tax from those particular projects, which ideally should go to the taxman. And that brings that small ratio in terms of GDP, tax to GDP ratio.
All right, another sector that I know my colleague Branji is very, very passionate about is the digital landscape. And Branji, you do a lot of stories about entrepreneurs and tech startups, but the government now wants a share of their money, and they are going, the taxman is going all out on them. What have been concerns in relation to entrepreneurs and how they're contributing to tax collections?
Of course, one of the biggest issues that is dogging the startup ecosystem right now, the unpredictable tax environment. And I wanted to ask Mokai this one. Now that he spoke about the informal sector, we have those startups that are, of course, registered, and then we have those that are not registered. So the government doesn't have a record of their location, a record of their income statements. They don't have a record of even their tax compliance. Now, this now brings in the question about digitization and including all of them so that they are not tax exempt, as you were saying. Talk to us about that, and what would it take to make sure that we are being fair to them and not introducing some interesting taxes across the year, because we've had minimum tax, DST, and there's going to be so many more others. Talk to us about that, digitization.
Yeah, it's an interesting space because there is a paradigm shift from the conventional way of doing business to the digital platform. And governments across the world, including the Kenyan government, has put up measures to try and see that they get a fair share of tax from that particular space. And that led to the introduction of DST, the Digital Service Tax. Though on introduction it was applying to both residents and non-residents, but subsequently there was revision to that, so that the focus only now lied on non-residents from both a VAT perspective and from an income tax perspective. But just to say, regarding the informal sector, there has been attempts to tax that sector, and in the past we had a presumptive tax which was introduced, I think, in 2020, and it was repealed in 2021. There was the introduction of turnover tax, which of course at a time in 2020 was running side by side with the presumptive tax. But still we are seeing, even after the review of the rates from 3% for turnover tax to 1%, to 1% of the turnover, we are still seeing, at least from the records which are available, we are still seeing a very low uptake of this particular tax by the informal sector. I think the government needs to do more, because there is belief and there is some level of understanding based on empirical analysis that quite a lot of taxes lie with this particular tax bracket, and to the extent they are able to be brought to the tax bracket, then the taxman is likely to collect more, and this will enhance our tax duty.
Interesting. And again, still talking about the issue about taxation, we have the controversial minimum tax. And with the risk of running into sub judice, we'd like to speak reservedly about this because there's a petition apparently. KRA will be lodging a petition in court concerning the resumption of the minimum tax. And most startups, I've heard from them, they keep saying that this is a tax on capital. And even manufacturers are not feeling very excited about that appeal. Is it time yet to introduce such kind of taxes like minimum tax? And where do you stand on this?
My view is actually aligned to your view that for startups and for companies which are quite capital intensive, at the beginning you are not likely to turn around your business to make enough income, which will enable you to be in a profit position. Effectively, then you will be paying tax on your turnover, and since you have not made a profit, this will be a reduction to your capital. And to that extent, then basically the government is running you out of business. But the introduction of minimum tax was a noble idea. I think the idea was to try and ensure that every person gets to contribute, to the exchequer through tax. But I think we should see more exceptions and more exemptions on who should not account for minimum tax. Especially, we think micro, small, medium enterprises should be exempted from that, from minimum tax. We have seen a couple of other sectors which have been exempted, including the regulated sectors like OMCs, the oil marketing companies, and other sectors which have been exempted. So either more exemption should really be done to capture sectors which are quite sensitive and which are low margin businesses.
Let's talk about the general businesses now, not just startups. And as we bring this to a close, Rwanda has some of the best tax implementation policies. For example, if a policy is passed in parliament right now, it takes effect in another 3 years. That means it gives the business a bit of time to catch up and comply. Do you think our implementation process is a bit too, is it ambitious or punitive in a way? Because always the business environment has to complain, it has to be rattled by this, because a tax policy is enacted today, it is implemented next week, and sometimes businesses are not as fast to adjust. They have to revise their budgets, they have to look at a lot of things, income statements have to be made, and all that. So talk to us about the implementation of tax policies as it should be. Now this is general for startups and blue chip companies alike.
Yeah, so we have there's a ruling that the High Court provided in 2020, I believe, which provided that at least the government needs to publish the finance bill before 30th April of every year. And the whole essence of that was just to ensure that there is predictability by businesses as to what changes, tax changes that the government intends to pass in the next fiscal period. And of course, we are a couple of days. We just started April, so we have a couple of days to end of April, which is the deadline by which the government should print or should publish the finance bill. And the beauty of having that in time, and the reason why that really came to being, is because as a business, if I need to configure my systems for me to comply with a particular legislation change, then I need time. And in the past, what we have seen is, for example, excess duty was introduced on financial services, and banks took a long time to have their structures and their systems configured so that they can be able to implement that change of legislation. And that led to non-compliance, which later on we saw so many disputes between banks and the Revenue Authority. So yeah, indeed I agree with you that businesses need to be given time to implement any change in tax legislation so that they can then comply. Otherwise, there's a likelihood that there will be dispute between the authority and businesses.
Fair enough. Brenda, I wish we had more time.
Yes.
But do you want to talk about the return on investment on some of these finance bills?
Absolutely. And also we want to expand more about the base and, what the government can do in terms of increasing its collection. And now that you said the presumptive tax and also the minimum tax, they keep on introducing them, but then again, scaling them backwards. So, what can be done going forward? And perhaps even next time we will invite KRA. I've seen they liked your tweet
Oh,
so you
really?
never know.
Amazing. I honestly wish we'd have more time because the other very pertinent issue is, and Mokaya, we're going to invite you sometime later on in the year about this. Are we seeing a return on investment on some of these finance bills that are being introduced when they're introduced? Because sometimes we introduce new taxes to get more revenue so that government projects can be done and debts can be paid and all these things, but are we really realizing the ROI? I think we need to do like a tracking down, a monitoring of 1 year after this bill has been in. We talk to KRA, what are the numbers?
Absolutely. All right, thank you so much for joining us on Business Cafe. I have been your host, Brenda Kirubo, and of course, Mokaya, who has given us insights in relation to tax collection. It was such a pleasure having you, Mokaya, and you know, you're welcome again to talk about the budget. And of course, my colleague.
I am Brian Jolotieno. Many thanks for your invaluable company when you are sending love to our senior